Thanks for staying on with us. Still tuned into First Trades, and the momentum intact at 13,430, up 0.5% across the frontline indices. Names like United Breweries, HDFC AMC, D-Mart, Reliance Industries, as well as HCL Technologies. They're showing you quite a bit of leadership this morning. But let's deviate then and also focus in on the overall PE deal market. Are we seeing India and Avid market currently? Are valuations starting to look stretched? And how does India really stand versus the rest of the world in terms of what the high frequency indicators are pointing towards? To understand that and lots more, we're joined by a special guest, Sanjay Nayar. He's the partner and CEO at KKR India. Thank you so much for taking time out and being with us. Hope all is well at your end. I just wanted to understand what the sense is currently when it comes to PE money in terms of flows into Indian companies versus the rest of the world. Which are the sectors that are looking good for investment in this current pandemic when things have shifted ever so drastically?
Thank you for the opportunity. I think, look, PE capital is going to keep flowing into India. And there are a couple of reasons for that. One, obviously, India represents a fantastic growth market, whichever way you look at it, barring the last few quarters. Secondly, India needs capital for growth. We don't have that much of local, long-duration capital, so you end up importing savings, and that's what the private equity and the venture capital industry represents. So I see, driven by growth opportunities, driven by consolidation, driven by deleveraging, I think you will see quite a lot of private equity flow that will keep coming into the country. I would say the biggest factor that drives this and makes people even more encouraged is, I would say, some of the reforms that have happened in the past, the way the pandemic has been handled, but more importantly, how the government has taken a very calculated fiscal risk, very calculated, very calibrated, and very directed. So that is, in a way, a pretty conservative approach, and that is why you have macro stability. And I would say third is that there is a immense shift towards digitization, data, and I think that has been, in fact, accelerated because of the COVID. So I would say that's the backdrop. For all that is said and done, you have a lot of macro stability. The growth, we can talk about that later. The growth opportunity is obvious. And the whole digitization of the economy, I think, is going to be a pretty big deal.
So if you could specify then, Sanjay, which sectors are looking appealing right now for investment in the current climate?
I mean, if you just look at sectors today, everything in the market looks pretty expensive. So frankly, it's got to be sector by sector, deal by deal. But I would say generally, taking a cue from what's happening in the macro trends, I would say clearly, parts of the IT sector, definitely exports, pharmaceuticals, and I would say, obviously, the big retail plays and the combination of digital and retail plays, which are going to be quite interesting because consumer behaviors are changing dramatically. I don't think any of us can guess right now structurally where consumption will land and structurally how you will experience experiences and shopping, but it's clear that is moving hugely digital. So I would say providers of those services will look very attractive. But, a little early to say because I think we have another couple of quarters of COVID uncertainty to go through. We also need to see whether this consumption that is coming up right now, is it structurally sustainable or not? And on the supply side, clearly we have two big drivers. One is the government's infrastructure spend, which is obviously going on. And then we need to see the private sector stepping up on the supply side to make fresh investments. I think that's still to happen. As of now, the deals are mostly, leaving out all the Reliance deals that were pure growth capital or deleveraging capital. I would say most of the deals right now are more to do with opportunities where we've yet to see new capital coming in for growth. A lot of this is different kind of situations. So I would say give it another 2 quarters, it'll be pretty clear. And when that clarity comes in the growth, you'll see another flood of growth capital coming into the country.
Hi, morning. Good to have you on the show. Are you back in Mumbai or still beyond city limits?
I am today beyond city limits, but I'm coming to Mumbai today. I mean, now we spend pretty much a few days a week in Mumbai. So it's...
Okay, so life's getting back to normal. Tell me what's happening with credit growth, Sanjay, because, as I see, that's not taken such a bad hit on either the NPA or the dispersal front. The financial index, in fact, has regained most of its lost mojo. Will credit growth grow in the same way as it has been in the last 5 to 10 years? And are we back to pre-COVID levels in that sense?
I think retail credit will come back and is coming back. Corporate credit goes back to my earlier answer about private sector making up its mind to invest again. And when they do that. So answer is not clear. I would say right now, maybe you're looking at the base effect and you see numbers going up. But frankly, I don't think we're anywhere near where we used to be. Not just pre-COVID, I would say, but pre 3-4 years. The financial sector, I think, is just, getting enormous amount of inflows. There's no doubt about it. Some banks obviously were unduly beaten up, and I think those are coming back, and that's fine. And some are getting even more expensive. So, I think credit growth is not the real signal here. It is about the other income and the opportunity that these banks offer to their consumers and to their corporate customers. I think that's what's driving these valuations for the time being. But I would say the sector generally looks pretty expensive, is my view. And also the moratorium, let's wait for December end when the one-time restructuring deadline gets over. Let's see what comes out of the moratorium. I think a lot of the bad news potentially, I'm not sure, could be hidden and therefore may not be entirely out as yet. And therefore, I think one has to be a bit more cautious. I would say, again, 2 more quarters just to see what's the real quality of the credit books.
Sure. Fair point. Since we are on the subject of banks and financials, what is it that you're making of the new draft guidelines and banking licenses and how that's going to change the entire landscape of the banking sector?
Well, firstly, by the way, it's only a IWG report. So let's be clear, there's no guideline or there's no directive as yet. I would say that clearly India will need a lot more credit availability of different kinds into different customer segments, different parts of India. If you have to achieve this 5 trillion vision, I think that's absolutely critical. Secondly, I don't think the existing banks in their current form can necessarily achieve that. So I think the idea of having new ownership or giving licenses to some of the larger NBFCs, which are systemically important and doing a very good job in terms of differentiated credit approach and differentiated penetration of the markets in different segments, I think it's a really good idea. I don't think the banks can ever get to that level of risk management and agility the way some of the NBFCs have demonstrated, especially the consumer side NBFCs. So I would say there is a couple of things in the IWG, the way I look at it. One, I think they're making a path for differentiated large NBFCs to have an access to become a bank. Whether they do it or not, that's their choice. Second, I think there is clearly a path being shown for harmonization of certain rules, legacy-wise, whether it was shareholding or it was IPO timing or it was ownership of subsidiaries. I think a fairly high degree of harmonization is trying to be achieved at the kind of, trying to balance the legacy as well as the new, the kind of the new paradigm. So I think the final question is, the corporates being allowed into banking. I don't think that's what the IWG said, but I would say that there is clearly a path for a corporate conglomerate which has very large NBFCs to be able to get a banking license in the NBFC, as long as they can protect different subsidiaries. And I think what this IWG report has done, it has really motivated everyone to think about the NOFHC structure, which is a layer in the middle that separates the lending activities from the balanced conglomerate. So I would say as an interim report, I think it's a very, very good shot at thinking through some of the issues and balancing the legacy versus the present and providing new credit growth into this country if you have to achieve those economic targets.
Okay. Sanjay, what's your view on the real estate market? The residential cycle does seem to be recovering. What do you think?
I'm not a real estate expert, so that question I can't answer, although I do hear a lot of anecdotes of people buying bigger and bigger flats, bigger and bigger. I think the GST impact has helped a lot. I think people are discovering that having larger homes, larger space is a good idea. Affordability is there, and it's been increased even more with all the interest subsidies and schemes. So I think it's a great, well thought out driver, both by the government as well as by the builders, to finally get the sector back in action. Look, we need the real estate sector. There's no doubt about it. It is such a multiplier of growth, a bit like infrastructure. So I hope it works, but I'm not an expert here.
Okay. And at this stage, in a late stage, in a 9-month bull run that we have seen, are valuations now looking stretched, or are we only just about starting to pick up pace given the kind of growth that we're anticipating here in the Indian market?
I think it's anticipation of growth. And as I said earlier, let's watch for 2 more quarters before we declare that it's sustainable. Again, it's a sector by sector issue. Second thing is there's a flood of capital coming to the country. As I said earlier, it's the macro stability, it's the opportunity in the country, and it's some high quality companies that are attracting a lot of capital. So that will continue. Third, is it vis-a-vis China and other emerging markets? I'm not sure, but there could be a reason there as well that people are reallocating towards India just from a longer term perspective. So I think valuations look high. So let's look at 2 more quarters and see. Maybe the markets will be right. So.
All right, Sanjay, we'll leave it there. Great chatting with you. Thanks for joining us this morning.
Thank you, Aisha. Thank you, everyone. Thanks. Bye-bye.
Giving us an insight, really, on some of the deal buzz currently.